Hello and welcome to the sentiment analysis for the week of May 3rd. Let's get straight into the details. What we're looking at on the screen is an analysis of the Euro USD. It's going to have even more relevance in a few minutes when I get into my actual charts. But for now, we need to have perspective of what you're actually looking at. This is where I start my research with the asset itself. And since I trade Euro USD as my primary, I needed as much data as possible. Now this is a part of Jackrabbit Relay, but let's get to the nitty-gritty details, the things that really matter. The range of the asset, the high, the low, and the spread, or the distance between the high and the low. In looking at something that I wanted to trade, I needed to know how big that market was. What was the absolute worst case chance of buying in at the highest high and then having the asset tumble downward to the lowest low? Or vice versa, buying in at the lowest low and then having the market go against me at the highest high? I predominantly short the market. So for me, both directions mattered because I needed to figure out which way do I trade. Do I trade on long positions only in favor of the euro, or do I trade on short positions only in favor of the USD? They matter because when you look at the market statistics, this data tells you exactly the kind of market you can expect. And you need to have numbers that realistically shine above a particular median or criteria. That is, you just don't want to jump into the market and think that it's going to go your way. You want to know which way the market goes predominantly. So from the standpoint of my analysis, that's exactly what I did with the median. I figured out where the middle was between the highest high and the lowest low. And then I figured out whether the market was above, below, or crossing that point by what percentage. And for the 23 years of this market, 62% of the time, the market has been below the market median. So 62% of the market is in a short favored position. That's important because that means that I have a reasonable expectation that if I open a short trade, the vast majority of the time, I will likely win that trade. But that isn't enough information. The market is always moving, so I needed to actually check the market average of all prices throughout the 23-year history of the market. And that gave me another answer. 51% of the entire history for the market average is also below average. So this market is below the median and below the constant running average of its entire history. So between both of these facts, I have a reasonable assessment that if I open a short position, I am likely to have a profitable position. Whereas if I open a long position, I am less likely. Now, if the market continues to change and the average goes above the market, meaning that at some point the average is higher than the average price, or the market is above the average price, then I have a split, and that's going to be problematic. And we need to look at other options. Those other options are exactly where the market is always above the median or the average. And that is either 28% or 38% of the time. So even if you look at just the above average settings, you still have a clear direction of market presence, of market intent. So using this kind of information is critical. Now let's look at the monthly movement. The highest time frame for this asset is 1 month. Monthly movement, that tells me a lot of information. 2,171 pips, maximum monthly movement. This literally means 13% of the entire market moved in one huge month. That is devastating. That is where you are going to take stop losses. I have 73 levels in my grid, and there are 20 pips between each level. So I can handle reasonably 1,400 pips before I take a loss. So this helps tell me that there is a potential that I will be decimated in one single month if I don't pay attention to the market. The average is 2.96% of the time. So the average monthly movement is 0.0475 pips. So what you have is a clear consensus. I have roughly 1,400 pips of movement. The average market is slightly less than 500 pips of movement. Therefore, I can handle roughly twice the average month. It's comfortable. It's not necessarily going to be the best, but it's comfortable. It's reasonable. But that brings us to something that I planned out when I did my analysis. And that is, I looked at every single time frame this market represents. And I did a complete and total analysis across the board. And that means the average is 1,400 pips a month. If I could stay within this range, I've got a good chance of making a long-term profit. That is important. And that's exactly how I picked my levels. 73 levels times 20 pips. Well, that puts me just above 1,400. So it gives me a reasonable approach. It gives me a reasonable average expectation of how I can survive the market. It's not perfect. Nothing ever is. But it is rational. That is where you start your trading journey. Not with the charts, not with an idea, but by actually looking at what you need to stay in the market, what you need to use to help protect your own money, to figure out where your money is, to be able to focus on the market in a way that allows you to protect your investment. It's not perfect, but it doesn't have to be. And that's what leads us into looking at my actual profits. Going from analysis into where my real money is right now. The last 4 years I have been trading this process. Well, technically 3 years and 1 month, because I started at the very end of December of 2023 for this particular trading technique. In that time, I have made a net profit of $244. I have given back $99 in reductions. I have taken 35 hard stop losses, and I've completed 3,291 trades. I've made an average of 7 cents per trade, and I've given back an average of 3 cents per trade. My average profit per month is $60. My average reduction per month is $24. Now these values are values after the mathematics. So this is $60 to the good every single month after I have given back the $24 for reductions. The whole point of the reductions is to admit, to acknowledge, to accept that at some point in time you are going to take a loss. It's just a matter of how you choose to take that loss. You could either take a hard stop loss, as I've done 35 times, or you could give a little bit back on every single profit, as I have also done. And that is really the critical point. I'm not avoiding my losses, but I am taking them on my terms. By realizing that at some point I am going to lose a little bit of money, if I shave off my worst position over time for every single profit I make, then I have the opportunity to work in my losses in a way where I can actually year over year make a profit. There is where you find success. Not necessarily trying to beat the market or come up with some grand scheme that can always outsmart somebody else. That doesn't work, at least not in the long run. What works in the long run is understanding that there are people out there smarter than you. There are people out there with better equipment than you. There are people out there that can pay PhDs to do all of this for them. You can't compete against that. I can't compete against that. And I haven't even gotten into the institutions or the banks or the hedge funds that are also out there with teams of thousands of people doing the very same thing, trying to find a way to stay in the market and make money. So my approach isn't to try to outsmart them. My approach is to try to outlast them. The one thing I have watched and noticed in trading that gives this technique its advantage is patience. Most hedge funds, BlackRock being an example with its $1.2 trillion liquidation, get greedy. When they get greedy, they make mistakes. And through this kind of a careful, meticulous, patient process, their mistakes become my money. Not because I've cheated them out of it or done something unscrupulous, but because I built a system that understands risk. I built a system that understands I will take losses. I built a system that puts these losses on my terms. That is the secret of surviving trading. So now let's actually get into the chart and see what that looks like and what I think is going to happen over the next week or so. Here we are looking at the chart, and we see on the left-hand side how much exposure I have right now, how much margin I've actually used, how much margin I have available, and where I sit within my own markets. So even with a realized loss of $166, I am still doing well within my account. Well enough that I can continue. That doesn't mean that I can magically just go put everything in one position. That just means I've accepted losses as a natural consequence of trading. You have to have that mindset in order to ensure that you have a sustainable process. Even though the technique I showed you previously was completely successful, I have used other techniques that weren't successful. So overall, I have a negative $166 realized loss because some of my techniques didn't do well. That happens. That's normal. That's the way it is with trading. And those are the lessons that I used to build what I just demonstrated. A technique that helps me stay in the market sustainably. So let's look at the chart and zoom in to the most recent months. Now this is the beginning of May, and we can see It looks like it might be trying to trend upward. But we saw that back here, where it trended upward a little bit, then it collapsed. That's fine. That's good. We watch it. Is it necessarily going to be where we want to be next month? I don't know. But I don't have to know. I don't have to know what's going to happen next month because I've built a strategy that doesn't care. It simply assesses the situation and it sees if I have a reasonable approach for opening a new position. That's how you manage your risk. You backtest, you analyze, you find out before you spend a single penny. And then, even with all of that, sometimes you still make losses. And you need to recognize that and get out and start over. It happens. As we look for next week, personally, I don't believe there is enough evidence in what we see right now on this chart to suggest that we're going to break any patterns. I think the market is going to remain flat, and I personally am looking at reducing volatility to increase my number of positions. I know I can take 1,400 pips in 1 month's movement, but as we can see on this chart, I can reasonably assess that I am well above that process with where the prices are from previous months. Now, the past doesn't equal the future, but since nobody is a mind reader or fortune teller, it provides an educational assessment of what we need to use for planning a future trade. And I do this week over week so I can see and suggest where the market is. And if you look at last week's sentiment analysis, the area up here was very busy. The area suggested that the market might actually want to push higher. But now we can see that the entire buy-sell dynamic has actually been pushed downward, meaning buyers and sellers both agree to lower prices. That's an important distinction within the market because it helps us determine exactly how we want to proceed. My current strategy is to short the market. I am significantly involved in that direction. But the market is telling me that is where it wants to go by its participants. So, we clearly see the pattern. We clearly have the pattern. So let's go back and look at history even more in depth. We can see now where we actually hit the lowest low. And we can see where we hit the highest high of this current range. This is how you determine your risk, by looking and making an educated guess. The market has not shown an interest in breaking the highest high. Participants have not shown an interest in driving above the highest price of this range. So that is a clear indicator that the market is likely either going to continue to go in this range or push downward, potentially breaking this range to the low side of pricing. And we can even see that historically as well if we go backwards. We can see the last time the market did test the low range, which was back in May to October of 2022. The market did break the low. That's important. So we can see where the market is likely to have a potential for where it might go. But if we keep going, we can also see that the high was broken back in 2020 to 2021. Again, looking at how this worked, looking at where the market went, and looking at the incredible cascade of negative movement, month over month, of just pushing downward, hard and aggressive. This is a trader's worst nightmare. This is the biggest fear of anybody with a position open, that the market is just going to go against you in such a ruthless, vicious way. And it's something that you do need to focus on as a trader, as an individual who puts your money in the market. And we go back further, we can see a history of this range. We can see again back in 2017, 2018, where we broke the highest high. But we see the range, the sweet spot of the history that we are at. And this is the point of why this type of analysis is so important as you look at your trading next week, as you try to figure out where the news might take the market, as you try to figure out how to protect your money. From the caliber of what we see of the chart, for the history of roughly 5 years, we are reasonable in the direction we are going. We could reduce the volatility sampling and make our trades more frequent as long as we don't get too extreme. We could increase our risk slightly and become slightly more profitable. Small changes over time. So let's get into what I think is going to happen next week. Truthfully, right now, looking at where buyers and sellers have their orders placed, not a lot. I really don't think we're going to see much activity at all. The bigger players don't look like they're moving. Retail looks like it's happy where it's at, and the order book clearly agrees with that direction. If anything, we might have a lower price opportunity, maybe down in this range. But again, that's speculative, only because if you look at last week, we saw just how much this order book went down. So if that direction continues over next week, then the order book will shift even lower. But I don't think it's going to break this lower range here on the screen. I think it's going to maintain this block for now. That's not to say as things progress, there might not be some event that actually changes that. But looking at what we see now, I think it's reasonable to suggest that we're going to maintain the pattern we have seen over the last several months for at least the next week. So trade smart, trade safe, but most importantly, analyze the market. Make your decisions based upon real market data. Look at the entire history. I based my decisions for my trading on 23 years of data. It took a long time to collect that data, to analyze it, to even figure out what I really needed. That is what is going to carry you forward and keep your trading safe. Share your thoughts, leave a comment. Let me know what is going on in your world, what pairs you are trading, and hopefully as we progress through this next week, you will have good trades. Thank you for watching.